The 2023 stock market rally just got a lot healthier in June and July. Yes, folks, what was once considered a rally held up by the big seven tech stocks is now broadening out to small and mid caps, particularly those in the growth and unprofitable sectors. This is truly a huge deal for anybody who's trying to understand where US markets could head into the end of the year. As inflation has meaningfully resided and interest rates continue to get hiked with expectations of cuts in 2024, markets really have a big runaway to rally over the next 12 months. And even if you see some prices as expensive in certain stocks, in this video I'm going to show you that right now may still be an opportune time to continue investing. And why exactly do I say that? Well, the number one most important reason is that most people are still doubtful of this new bull market having started in 2023. If you look at social media or even most Wall Street analysts, short positions are still increasing as people are fearful that another correction or a recession could be on the deck. But as I've shown you multiple times over the past few months, that is simply not going to happen, barring any sort of black swan event. You see, folks, what has happened over the past 6 months is purely textbook. I've talked about this situation in many videos, but because markets tend to be forward-looking and it's pretty easy to see the trend of inflation, there is a lot of reasons for why investors could be optimistic out of this new bull market. And so far, the 73% rally that we have seen in the S&P 500 really goes to show you the strength and validation of that thesis. The Fed's own preferred measure of inflation in the PCE has dropped to 0.2% growth month over month, with its year-over-year number sitting at 3%. That is the lowest since 2021, which really goes to show you why markets have a lot more room to run. Because as we know, folks, interest rates tend to be an indicator of where investors are positioning themselves. And if rates are really high right now, it means there's an opportunity for more monetary stimulus if rates are cut anywhere to 2 to 1%. Because as you can see, folks, higher interest rates have resulted in the financial conditions also hitting a near-term high. We're sitting right above the average of around 400 on the index. Meanwhile, the market has rallied 30% so far in 2023, which again is trying to front-run any sort of stimulus-based rally we could see in 24. And guess what, folks? For anybody who still believes that this rally is a bear market rally and that a recession will eventually still lead stocks lower, they might just see a huge reality check right in front of their eyes. Because, as you can see, folks, the soft landing goal of the Federal Reserve is playing out perfectly right in front of our eyes. As you can see, although the Fed funds rate has climbed to 5.5% as of the time of filming this video, unemployment is still sitting at 3.6%, basically flat from the start of 2022. There's a really important reason, folks, for why this is happening, because most of the layoffs we're seeing right now are happening in the technology sector, which in and of itself was a key beneficiary of the pandemic lockdowns. This isn't to say that those jobs are not real jobs, it's just that the unemployment rate inside the US does not skew towards heavily what is that in technology, unlike the S&P 500. As we know it, over 50% of the moves are driven in the S&P 500 by the top 7 tech stocks, which means that overall there is a skew towards high growth and highly profitable names, which is not what most of the economy resides on in the US. Most jobs in the US are built by small businesses, whether that be restaurants, contractors, or home builders. It's these small businesses that are not represented in markets, and they're the ones that are showing us the leading sign of how strong the economy really is, despite the financial tightening. And that, folks, is just yet another reason for why the bull case for stocks continues to improve and why most traders and investors are trying to front run it as best as possible. So far, the S&P 500 has rallied from its October lows for more than 189 days, which just so happens to coincide with the length of the 2022 bear market. And if you look at any bear market over the past 123 years, folks, almost all of them have seen the new bull market start when the new uptrend lasts more than the previous bear, which basically confirms the fact that this new rally is indeed a bull market. And what's more to love, folks, is the fact that this rally is finally seeing a broadening into growth stocks, unlike what we saw for the first 3 months of this year. As you can see by the iShares Russell 2000 Growth ETF, markets are breaking out. Whether or not this is reflected on your own stock portfolio depends on what specific industries you own. But personally myself, I have seen my portfolio go up significantly just over the past 30 to 60 days, and it has everything to do with this specific index. Growth as we know it tends to be the first one to sell off and the last one to recover in a new bull market, and we are seeing the repercussions of that just right now. Although my own portfolio is skewed heavily towards electric vehicles, energy, and hydrogen, I am seeing still quite an indecent return so far this quarter of north of 77%. What all this means is that the most beaten down sectors are where the most opportunity exists right now. And although tech did the heavy lifting, now utilities, financials, healthcare, materials, consumer staples, real estate, and even industrials are joining in on the fun. And that, folks, is exactly why this bull market is far from over. The stocks that people talk about being the most overvalued are those in tech, but nobody talks about the rest 99% of companies that are either beaten down severely or seeing inflections in business fundamentals. And chances are over the next 2 years, we're going to see a face ripper rally similar to what we saw happen in 2020 and 2021, where people were in disbelief after the market saw a huge correction in 2020. Don't get me wrong, folks, there are going to be pullbacks and corrections. The point really is about the new trend, which means that markets are going to make higher highs and higher lows instead of making lower lows and lower highs. And keep in mind, August and September tend to be some of the worst years for the market, which means that chances are this rally could see one of those corrections happen within the next 30 to 60 days, which could be yet another great opportunity to increase exposure. As for what I'm doing, I continue to average in and buy some of my favorite companies with whom I'm seeing fundamental shifts for the rest of the year, whether that be in electric vehicles, energy storage, green hydrogen, or even software like Coinbase or C3 AI. I continue to be a long-term investor. As usual, folks, let me know your thoughts down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.